Policy Watch, the Monetary Policy Watch right here on ET Now, a special show that we bring to you live right here on the channel. I'm Supriya, Shrinate, and over the next 30 minutes, we will discuss and debate what the Monetary Policy Committee will do tomorrow, the implications of that move. Is there a case to now hold back on a rate cut? There are compelling cases to go ahead and cut rates. Will the RBI finally oblige? We are joined by a very esteemed panel here. We've got Indranil, Sengupta, India Chief Economist, Bank of America, Merrill Lynch. We've got Dina, Bandhu, Mohapatra, MD&CEO, Bank of India. We've got Dr. Arvind, Virmani, President Forum for Strategic Initiative, somebody who's been in policy making previously. Mythili, Bhusnurmath, our consulting editor, and Swaminathan, Aiyar, our consulting editor as well. So thanks to each one of you for being with us. And as we discuss this, I think the premise has been set by the ET Now poll, which very emphatically threw up that most people expect a rate cut of about 25 basis points. The stance may not change, that may continue to be neutral, but everybody is expecting a rate cut right now. Mythili, it's a given that the government on one hand, consumers on the other, there is a huge clamor for a rate cut. RBI has time and again said it's a data-driven organization. There couldn't be more compelling data to cut rates than today.
Well, yes, I would agree with you on that, Supriya. The data is pretty compelling right now because earlier there were some doubts whether the decline in inflation was transient or whether it was a more permanent structural decline. But now it would seem to suggest that not only in India but all over the world there is definitely a structural decline in inflation. So the RBI is in no danger whatsoever of breaching that inflation target on the upside. So clearly now, as far as the data on inflation is concerned, it's pretty evident or clear to the extent that any macroeconomic data can frankly be clear, because there are always risks. But by and large, one could say that on the inflation front, we are well within safe territory. At the same time, real interest rates are quite high for borrowers precisely because inflation has fallen so dramatically. So because real interest rates are high, there's another compelling case to cut interest rates. Meanwhile, our growth we find and in private investment we find has just not picked up at all. Latest data, particularly as we're seeing for core sector data that just came out yesterday, clearly shows that's just one more reason for the RBI to cut rates. So I think the question now is not so much whether the RBI will cut or not. The market has factored in a cut. The question is, will the RBI be brave enough to make it a 50 basis point cut?
So will it be a question of grit and determination over what the markets are expecting? You raised two important points there, which is the real interest rate, and I think there's a counter view in the RBI on could that evergreen NPAs. I'll come to that in just a bit. And the other point about private investment, will a rate cut at all fuel private investment is the other big question, because it's not just dependent on the RBI rate cut. But you've raised two important points. I'll come to you on both of those in just a bit. But Swaminathan, Aiyar, I want your opening remarks here. There has been a sustained fall in inflation. It has been persistently falling. The RBI has overshot its inflation targets by a huge margin. Will the RBI, with the Monetary Policy Committee headed by the governor, have the wherewithal, have the grit to go ahead and actually cut rates by more than 25 basis points come tomorrow?
Yes, I think it should cut by 50 basis points. I would say the RBI has been behind the mark on this and needs to catch up. It could easily have cut the rates earlier on also. It seems to be obsessed with fears of the upside of inflation. Now, even if there is an uptick in inflation, I will simply say that you are so far below that 4% benchmark, I really find it very difficult to understand why there has not already been a cut. So yes, if there is to be a cut now, I think 50 basis points certainly would be called for.
50 basis points would be called for. The RBI behind the curve. Those are the opening comments coming in from Swaminathan Aiyar. But I want to take this across to Dr. Arvind Virmani. You've been in policy making. You understand how Mint Street works as well. The question really is, look at the data. In October of 2016, and I want that data to really come up on our screens right now, retail inflation was at 4.2. It's down to 1.54%, which is lower than the RBI's own target for the first half year, which was 2 to 3.5%. Look at core inflation, because the RBI has always said it's core inflation that we're going to attack. Core inflation is down persistently for the last 2 months. 4.7 is where it was in October 2016, July 2017. That's the last reading of June. It's down to 3.72. 25 basis points, do you believe is going to make a difference? Or do you believe if RBI needs to make a difference, if it is serious about a rate cut, it needs to walk that extra mile? 25 basis points may not suffice tomorrow.
If you look at the way inflation has been going and the way we have been forecasting it for the last 2 years, it should have cut the rate by at least 1% by this time already. Now, that is what I believe it should have done, but that doesn't mean that's what they are going to do. Will they cut 50 basis points? I would highly doubt it. I think there will be some voices in the committee asking for 5%, but I would be very surprised if they actually do it. And the reason is because they went out too much on a limb in setting out the policy. But what are the aspects really which they have been emphasizing? One of the issues is that the previous governor had focused on end period inflation and used to talk about, let's say, end March or end of the year inflation. And this MPC and this governor are talking now much more about the average. That's where your reference to the first half and second half average comes in. The second aspect is that in fact the last governor had very strongly switched over to this issue of total inflation, total CPI inflation, because the argument was that one cannot exclude food because it's 50% of the basket and we are concerned about the impact on the poor. This governor and this MPC have been talking much more about core inflation. So, the problem is not that you take one aspect and then keep on it. The problem arises when you keep switching, when people don't know what your focus is, because then the suspicion arises that you change your objectives or what you're focusing on to suit your errors and your mistakes. That is where the problem is. So, to summarize, in my view, they should have already reduced repo rates by about 1%. Second, I think it's still not 100% clear that there will be unanimity on 25%, but I think it's very, very unlikely that they'll go by 50 BPS.
Okay, they should have done by 1%, but it's unlikely they will go by even half a percentage point, is the words that's coming in from Arvind Virmani. But I want to take this across to Indranil Sengupta. And Indranil, I'm going to ask you the more controversial question. Should India, should policymakers, should consumers, should corporates have waited for this policy to play that guessing game? Will the RBI, won't the RBI? Or do you believe that a rate cut was warranted even before the policy, mid-policy maybe? It has happened in the past. Why did it not happen after that inflation reading this time around? I mean, I'm really asking, I know I'm putting you in a bit of a spot there, but I do want an answer to this question that, could a rate cut not have happened before? And is it a given that the RBI will oblige tomorrow?
Well, we are expecting a 25 basis point rate cut tomorrow, something we have actually been calling for a long time. So that's number one. Number two, I am personally not a great fan of intermeeting actions because, unless there is an FX crisis, monetary policy works with long lags. So whether you cut, in a one particular week or 2 weeks ago, doesn't really matter. But I think the most important thing is that they cut tomorrow because that will send a signal for banks to cut rates before the busy season sets in October. If you delay now, then, the lending rate cut by banks will get postponed to next April, which is almost, which is a long way off. So I think, we saw this in 2015 when, the RBI pushed the rate cut to January, and naturally banks don't cut at the busy season, and then you start talking about the problems of, transmission. In 2016, you cut well on time in October, and banks passed on. So this time, if you cut in August, given that growth is so weak, you will see banks passing on lending rate cuts to the consumer, and that clearly will provide a much needed shot in the arm as far as growth is concerned.
So who better than a banker to pose that next question to, because you've given me a cue for that. Mr. Dina Bandhu Mohapatra, MD and CEO of Bank of India, is joining us as well. And thank you very much, Mr. Mohapatra, for being with us. Like Indranil, Sengupta and others on the panel have pointed out that the RBI must cut rates. There are compelling reasons to cut rates. Some on our panel have also said it shouldn't just be 25 basis points, which is what the markets have already budgeted for. It should perhaps be at least 50 basis points, which is half a percentage point. My question to you is, if there were to be a rate cut tomorrow, what happens to lending rates? Because the busy season kicks in. Do you believe banks passing that on? Because full transmission has not happened. Just for the benefit of our viewers, it's important to point out here that since December of 2014 and May of 2017, weighted average lending rate has gone down by 138 basis points. The repo rate has gone down by 175 basis points. So there is a divergence there. The entire thing has not been transmitted. I have two questions for you. What will ensure transmission? And do you believe this is the most opportune time for the RBI to cut rates? Because before the busy season kicks off, you will be able to pass on the benefits to your consumers. Mr. Mohapatra.
Yes, there is every possibility of RBI cutting the rate by 25 basis point. And definitely banks will also follow suit. And regarding you have mentioned that there is a gap between rate cut and then interest rate cut by banks. If you see, even without repo rate cut by RBI, last time banks reduced their MCLR by 80 basis points, 70 basis points. So that was because of liquidity available in the market. There are many factors they play, while deciding the rate cut. And today, everybody is expecting that at least 35 basis points will be cut by RBI. They may be having their own examinations, considerations, all those things, but everybody is expecting around at least 25 basis point cut will be there. And I'm quite sure that it will be definitely followed by the banks by reducing their rate of interest.
Mr. Mohapatra, 25 basis points rate cut by the RBI if followed by the banks. Do you see a significant difference to investment, to credit offtake that has been at multi-year lows? Mr. Mohapatra?
That very much. Even last time also we reduced around 70-80 basis point without any cut by RBI, but credit offtake is independent of all these things. Today market condition dynamics are quite different, and many other factors play their role. Credit uptake, of course, it will be going forward, it will be there, but you never know how it will be behaving, and the other factors are not supporting as on today. But it will be very good signal to the market when RBI cuts the rate and bank also reduces the lending rate. The perception will be good, and it will be having good effect on the economy as well, and the growth will definitely be supported by this kind of cut.
Fair point indeed. So this is a sentimental impact that the RBI could have. Mythili, in your opening remarks, you refer to the fact that private investment is at multi-year lows. The fact of the matter is that even though banks have passed on some of the benefits or some of the, repo rate cut, credit offtake hasn't improved. People are not willing to invest. Investment seems to be divorced from the rate cut or the rate trajectory in India right now. Will you disagree with me?
It is one of the major factors, but there are other factors also influencing the decision of the investment. And right now there is underutilization everywhere.
Right.
And there is the capacity.
Sir, just hold your thoughts. I was directing that. I get your point, sir. I was directing that question to Mythili. And Mythili, my simple point is that banks have done their bit. They have done a bit of transmission, but investments haven't broken ground. Is this rate cut going to be sentiment booster, or is this actually going to set the virtuous cycle of investment in motion, even if it does so sentimentally? Mythili. Okay, there seems to be a problem with Mythili's line. Can we please connect to that? Swami, if I may ask you the same question, you said it should be 50 basis points. Do you believe that has a more sentimental impact? It kind of, surprises markets on the upside. It sends out the signal that the RBI is willing to accommodate growth concerns. Or do you really realistically believe that this can have a real impact on investments, on credit cycles?
There are a number of factors which determine whether you invest or not. The rate of interest is one, and at this stage, a difference of 25 basis points in the interest rate would not be the critical factor for anybody to decide whether he's going to invest or he's not going to invest. On the one hand, take a look at the supply side. What is the demand you're seeing out there? The economy has slowed. There was the effect of demonetization, maybe some disruption because of GST. The net result is that there is no great buoyancy. There is no huge spurt in sales. And if you do not have an economy itself which is buoyant, there is no good reason for saying, I am going to invest more just because the repo rate has been cut by 25 or 50 basis points. If, on the other hand, the economy picks up, I mean, it's possible to take the optimistic view that the worst is now over. The impact of demonetization is over. The disruptive effect of GST, after 2-3 months, that will smooth out. And after that, we will get an upward push. It also appears that the international scene is brightening up a little. The United States is looking a little sharper on growth. The European Union is looking a little sharper on growth. So if external demand picks up, I think that may be the most important factor determining whether or not we get a spurt in investment. The fact of the matter is that we've had hardly any export growth for the last 3 years. First of all, exports fell and there has been some recovery in the last 10 months. But the overall picture is not one of buoyancy. Nowhere in the world has an economy managed to do 7 to 8% growth over more than a very short run unless there is a boom in exports. So, we need our exports to boom. Our exports boom is going to depend on the extent that the world economy picks up. So I would say that the most important thing is if there is some pickup in our economy, but even more important, a pickup in the global economy, then I think a 25 or 50 basis points thing could help spur investment. If you don't get those other factors, then I don't think the interest rate alone is going to spur any growth of investment.
Okay, that's a valid argument indeed. But Dr. Arvind Virmani, I want to turn the focus and talk to you about the real rates. The real rate in India stands at 4.8%, which is, I think, the second highest amongst its Asian peers. If you look at what SBI did, which is cut its savings rate, it is a function of that. My larger question is, do you believe at this point in time, when there is an NPA resolution happening, when there is insolvency being declared by the RBI, they're trying to clean up that mess, one of the views is, and one of the arguments is that a rate cut at this stage could evergreen these NPAs. And the RBI may not say it, but is perhaps comfortable with a high real rate in India at 4.8%. Do you believe that's an argument that cuts ice with you?
So here's the thing, when people talk about investment, I am a little puzzled that they focus on 3 months. When we talk about monetary policy, the monetarists talk about it, they always say we are directing monetary policy to 18 months ahead. So why is it then when we talk about investment, we are talking about what's going to happen tomorrow? So I find this basic contradiction, confusion. What is the purpose of monetary policy? So the important thing is, what is the channel through which this real interest rate are going to affect? So let's look very quickly at it. One, the most important is consumer durables. Interest rates will affect consumer durables and real estate purchases, which will raise demand for the corporate sector and will increase capacity utilization and lead to more investment. So I don't think anybody who talks about investment really, this is excessive because we want to dump this issue. We always think as if interest rate has a direct effect. Somebody is calculating it's 2% and I'm going to get a 2.3% return. It doesn't happen like that. The second channel is the NPAs. We are talking about low credit, partly because of NPAs and the dual debt problem. So what's going to happen? What has happened is that high real interest rate makes the NPA problem worse, not better. So if you have a real interest rate which is realistic, which is justified and which is valid, it will be easier to correct this NPA problem. Part of the processes are already underway, the bankruptcy law, the actions taken by the government. Again, nothing is instantaneous. So I would expect that in 12 months, the effect of a proper real interest rate working through both the consumer channel and the NPA channel will lead to higher credit and higher investment. That is the channel I see. That is when why we say the monetary policy doesn't affect instantaneously. Why do we expect that it will affect investment instantaneously? So I find, I'm sorry to say this, but I find a lot of this hand waving to justify wrong policies of the RBI.
Okay, I'm not going to justify the wrong policies of the RBI because I think I'm in the camp that believes there could be a rate cut and that will do some good. But okay, but Mr. Mohapatra, if I may come to you, sir, you're the banker on the panel. The point that Mr. Virmani made, that, you know, real rates being high, and they stand at what, 4.8% today, are not good even for NPA resolution. The counter argument that's being made by some people within the RBI is that this high real interest rate will ensure there is no evergreening of NPAs. As a banker, how do you read this real rate being high?
You see, in any economy, there are major drivers, three major drivers are there for economic growth. One is consumption, one is investment, and the last one is export. So all these three are major drivers of economy. And by cutting this rate, definitely one of the drivers will be activated, and that will activate the other drivers, and that way, economy works out. And it will be definitely beneficial for everybody. And thinking the other way that, it is late or, it should have been done earlier, that is a separate issue. We are not here to comment on that. But my conviction is that if they do that, 25 basis point after a long time gap, that will be very good, signal to the market, which will definitely, go for more consumptions and good for sentimental purpose, and it will definitely lead to more growth. And going forward, busy session will start after October. It will be a busy session for the economy. Generally, economy, takes off in the busy sessions. Before that, this rate cut happens, and bankers also transmit to their reduction rate of interest. It will definitely good for the economy, good for everybody.
Good for the economy, good for everybody. But Indranil Sengupta, I'm going to ask you a quick question before I take it across to Mythili, whose line we had lost. Mr. Sengupta, the question has to be, what are the risks to inflation? Let's just step back and be the devil's advocate for a minute and see why would the RBI hold back? One of the reasons is tomato prices are very high. The other is crude is beginning to inch up, but still very, very benign globally. HRA of the 7th Pay Commission and GST. I just want you to reason out. All of those points are actually points that have a counter argument to. I mean, tomato prices are really beyond the RBI to be fixed. Crude is extremely benign for a very long period of time. GST, if anything, they would want to see the rollout and the execution to happen, will perhaps surprise us on the downside as far as inflation is concerned. The rates are, very non-inflationary if figures and data is to go by. So I'm just trying to understand from you, what could the factors be on the minds of MPC members, people like Viralacharya, people like Apami Dua, people like Mr. Dholakia or Urjit Patel? What are the factors that's going to hold them back and say, we are going to be cautious? Are there any factors on the table at all?
Well, GST is clearly neutral to inflation. Rains are, running at better than IMD forecasts. The 7th Pay Commission house rent allowance, it is statistical. I am not able to understand how that can have second round impacts. It is beyond me. We do think that the base effects that will reverse in the second half of the year. We do think that inflation will go to, closer to maybe 4.5% to 5% towards the second half of the year, basically on base effects. But that's all right. On the average for the year, you're going to have inflation around 3.7%. And to my mind, this low inflation is not desirable. You have low inflation because you have poor growth. So, essentially what you need to do is get back to a normal rate of growth and a normal, long run inflation of maybe 6%. Growth goes to, let's say, 7%, 7.5% in the old GDP series, maybe, in the late 8s in the new GDP series, and inflation also goes back to what it is at the normal 6.5%. So from any way you see, whether it is from inflation risks, whether it is from growth risks, very hard to make a case, in my view, that suggests that you don't cut rates tomorrow.
All right, very hard for anybody to believe that the RBI will have a reason to not cut rates. But the final word, as always, is with Mythili Bhusnurmath. And Mythili, I'm sorry that line got lost with you. We did address the points that you raised about the real interest rates and private investment. But I'm going to ask you a very simple question. Will Urjit Patel and his tribe join North Bloc and be a growth warrior come tomorrow? Is there too much societal pressure? Is there too much pressure on this policy to oblige on rates? And can the RBI, shock us otherwise?
Well, I hope the MPC and the Reserve Bank of India does not respond to pressure, but responds to the sheer logic of cutting rates, precisely because of macroeconomic fundamentals, and the data suggests, in fact urges, that it cut rates, not because of pressure. In fact, the whole idea of moving to an MPC was that it would be able to resist pressure much more than a single individual. So I do hope the MPC and the RBI cut rates tomorrow, not in response to pressure, but because of the sheer logic of the macroeconomic fundamentals dictate that they cut rates.
It's a data-driven organization, and every data that you slice, dice, read in entirety tells you that India should have lower rates than what we have right now. But thank you very much on that note, Mythili Bhusnurmath, Swaminathan Aiyar, Arvind, Virmani, Mr. Dina, Mohapatra, and of course Indranil, Sengupta, for joining us on this very special show, the Monetary Policy Watch. Keep it with ET Now for the best analysis and the expert commentary on RBI's monetary policy.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.